It's a great day at Equity. Today we are going to discuss how collections, charge-offs, and disputed accounts that appear on a homebuyer's credit report relate to each of the following loan programs: conventional, FHA, USDA, and VA. Since each loan program has different guidelines as it relates to derogatory debt, it's important to know the difference. Unpaid collections may affect the ability of a buyer to repay their mortgage in the future, so to minimize these risks, lenders consider the following during the loan process. First, let's talk about conventional loans. Non-collection accounts that have past due balances must be brought current. For single-family, owner-occupied homes, buyers will not be required to pay off outstanding collections or non-mortgage charge-off accounts, provided these events will not threaten the new mortgage's first lien position. For multifamily homes and second homes, collections and charge-offs totaling more than $5,000 must be paid in full prior to or at closing. For investment properties, individual collections and charge-offs equal to more than $250 or the total of all these accounts cannot be more than $1,000, or they must be paid prior to or at closing. In the case of a disputed account, Fannie Mae and Freddie Mac tools have taken information provided into consideration and let your loan team know if any additional documentation will be needed. Monthly payments for disputed trade lines must be included in the debt-to-income ratio if the debt belongs to the borrower. Now let's talk about FHA guidelines. If the total balance of collections accounts is $2,000 or higher, there are three options available: payment in full of all outstanding collections, documentation of payment arrangements, and these payments must be included in the calculation of the buyer's debt-to-income ratio for loan approval. If payments are not established, a buyer may be able to qualify, including a calculation of 5% of the outstanding balance added to the debt-to-income ratio. It's important to note that FHA does not allow collection accounts to be paid down to an amount under the $2,000 mark to bypass the payment requirement. Charge-off accounts are typically excluded from a buyer's liabilities. Disputed accounts are generally only considered when the balance is $1,000 or higher. The next loan program to review is USDA. For USDA loans, the total amount of collections among all applicants on the loan file cannot be more than $2,000. USDA also considers any collections of a non-purchasing spouse in a community property state unless the state prohibits this. For more detailed information, you can reach out to one of our well-qualified mortgage specialists for assistance. If the amount of collections total $2,000 or greater, the following options will apply. The accounts can be paid in full prior to the loan closing, or payment arrangements can be made with the creditor and the payments included with the borrower's debt-to-income ratio, or 5% of the outstanding balance must be included as the monthly liability for the borrower. Regarding charge-off accounts, the underwriter will review the file and decide if an applicant is an acceptable credit risk, so really, it's an underwriter's discretion as to whether a charge-off needs to be fully paid. If there is a repayment plan, the monthly payment would need to be included in the liabilities. Disputed accounts must be considered if they had past due payments within the last 24 months. Our underwriting team will carefully review each USDA file and analyze if any disputed derogatory account has the potential to impact an applicant's ability to repay a mortgage. Each account must include monthly payments in the debt-to-income ratio. If there's a payment amount shown on the credit report, we'll use this. If not, we take 5% of the balance on the account. We can use the lesser amount if there is documentation from the creditor showing that they have approved it. Finally, let's talk about VA loan program guidelines. If you have a buyer who is a veteran, it is required that they address any past derogatory credit history. VA requires a letter of explanation for any past collections, charge-offs, bankruptcies, foreclosures, short sales, or any other late payments as they appear on the credit report. VA is the only loan program where medical debt must be included in a borrower's liabilities. All collection and charge-off accounts with a balance will be added to the debt-to-income ratio using the monthly payment shown on the credit report. If no payment is present, we use 5% of the balance. If the borrower is unable to qualify with the 5% payment, the debt must be paid off or a payment plan must be set up and documentation provided. In the case of disputed accounts, the loan underwriter will review the overall credit profile for the borrower to determine if any action is necessary. If you or someone you know is worried that less than perfect credit will stop you from qualifying, reach out to a mortgage specialist to learn more about different loan programs available. Thank you for joining us. Don't forget to like this video, subscribe to our channel, and turn on our post notifications to never miss a new video. Please leave a comment below if this video was helpful and if you'd like to see more videos on similar topics.